All right, my friends, I want to compare a bond versus a stock. I did a video last night after I put the kiddos down where I was using my man Dougie Fresh's bond holdings that he has and kind of analyzing these. And I tell you, it left a bad taste in my mouth. Not because I think he's a bad guy or anything, but I think he's taken an extraordinary amount of risk for what would be perceived as a safe asset. And I don't see the upside of this at all. So I've been thinking about this all day, actually. I was busy this morning, and then I said, and I was taking old Pablo for a poopy break, and I said, I've got to do a video on this. So I started analyzing a couple things. So I want to share this with you. All right. Let me go back to the premise. I was just reading an article the other day. The guy said, if you've won the game, stop taking the risk. It wasn't, who was it? William Bernstein. I.e., don't take unnecessary risk. It's almost like, who was I reading the other day, a couple of weeks ago? He bet $75,000 on the Patriots to beat the Dolphins. If he would have won, he would have won $8,000, and if he would have lost, he would have lost his whole $75,000. Patriots proceeded to lose, and now they're out of the playoffs, and he lost $75,000. He has $75,000 at risk for an $8,000 gain. That's just stupid. Don't do that. And I think this is a similar scenario here I'm going to share with you. If you're going to take the risk, you might as well get a good reward for the risk, if that makes sense. So let's dive into this. So we're going to look at a Kroger bond. So Dougie, all right, give me a thumbs up if you know who Dougie Fresh is. 6 minutes, Dougie Fresh, you're on. You know who Dougie Fresh is, huh? And Slick Rick, Dougie Fresh. Used to love Dougie Fresh growing up. I'm not sure if he's still the human beatbox, Dougie Fresh. I don't know if he's still around. I imagine he probably is. All right. I hope he didn't go gangster rap. That's embarrassing. Didn't MC Hammer go gangster rap? Oh, horrible. All right, so we're looking at Kroger. All right, so Kroger had a bond, and I think it was issued in 1999. It was a 30-year bond. I don't know that for sure, but it just looks like it was because it's going to mature in 2029 and is paying a 7.7% coupon at issuance. So here we got Kroger. All right, at one point it was issued for $100. That's called par value. Let me write that down. That's the par value. This is the maturity value. Par and maturity on a bond are the exact same thing. Par and maturity, exact same thing. All right. So it's irrelevant the bond was issued at or how long ago it was issued. That means nothing anymore because all that means now is how long for the maturity date. So in this case, you have a bond that's going to mature in 9 years. It's going to mature in 2029. So as issued, this is water to the bridge. It matters not. Right now it's trading at $135. So this is the current price. $135. All right, so we know a couple things happening here. We know a couple things going on here. This is what it costs to buy the bond now. This is the current coupon right now. And this is what it's going to mature at in 9 years. All right, so that's all we need to know so far. So we know we're paying a premium for the bond because we always know that the bonds most likely are issued at 100 or 1,000 or 10,000. This is probably a $10,000 bond. For some reason, they trade in numbers of 100, which actually is traded in numbers of 1,000, which actually is traded for 10,000. I don't know why. But anyway, we know this bond is trading significantly higher. This is the current price, trading significantly higher than the par value. And again, we don't care. The reason for that is that coupon is significantly higher than what you can get in the market. So we know from issuance in probably 1999, again, it just if you look, the rates in 1999 were pretty high. So this would make sense. It's paying 7.7% back then. The rates have fallen off a cliff. So we know that the rates have dropped. So that's a high coupon for this bond. High coupon relative to the current interest rates means the price is also high as well. So we know we're going to buy a bond at $135 in order to get a 7.7% coupon. So that means we're going to get $7.70 for every $100 we own on this bond. All right. And the current going rate on the market, the 10-year Treasury is 1.75. The 30-year Treasury is 2.2. Shows a significantly higher coupon than what you can get out there. So for that significantly higher coupon, you're going to pay a significantly higher price. All right, so now we know it's got 9 years. So if we pay $135 today on a bond that we know is going to mature at 100 in 9 years from now, you would think our current yield would be 5.7, which is true. That is your current yield, but that's not really relevant either because what we have to do is factor in what the current yield is going to be and take into consideration the fact it's dropping in value. So we have to look at what's called the yield to maturity. So your current yield, while important, that's not that important. Actually, the yield to maturity, some would call it an estimated yield. The yield to maturity is what's important. So in this case, the yield to maturity is 3.25. Essentially, we are paying a significant premium. We're going to lose all that premium by a capital loss, essentially. I can't remember if you can write that off. I don't think you can. I just can't remember. But we have a capital loss, but we are going to get a high coupon to compensate for our capital loss. When all is said and done, we're going to get 3.25 on this bond over the next 9 years. That's all that matters. How much we get in our back pocket? 3.25 each year for 9 years, or 3.25 annually. Now, so here's a current yield formula, which is coupon over a current price. So the coupon is 7.7, the current price is 135. You divide that together, you get 5.7, which looks very attractive, but it doesn't mean anything. It means something for dividends. It doesn't mean anything for bond prices. It doesn't. I mean, that's what you could say. Oh, I'm getting 5.7. You're not, because that doesn't take into consideration the drop in the price per bond from 135 to 100. So we look at what's called yield to maturity. You got to be careful on these yield to maturity things. This is the formula, which we'll go into in just a second. I was looking, I haven't had to do all this stuff in so long because everything's automated now, which is freaking awesome. But I looked at a yield to maturity calculator on Investopedia. It was horrible. I was like, that's not it. I was like, huh? I was like, I don't know what they're talking about. And it's weird, which if you haven't been around long enough, you might not know, because it's Investopedia. And I said, I don't know how that's even. It was weird. So anyway, I looked at another place through, I think, CFA website. I can't remember. And I found the right one, which is this. And look, there's just use a stupid calculator. Excel spreadsheet and all that's fine. But if you want to know, yield to maturity is you take your current coupon. So you put that aside, order of operations, you take your future value, which is 100, because that's what's going to mature, minus your present value, which is 135, and divide by how many years to maturity. In this case, it'd be 9. So we take future values, 100 minus 135, and we divide by 9, whatever that gives us. And I forgot off the top of my head. You take your future value, which is 100, plus your present value, which is 135, divide that by 2. You divide these together, and whatever that is divided by that, so that's x, that's y, equals your yield to maturity, and then your yield to maturity, in which this case is 3.25. All right, so now that's the bonds. All right, so that's Kroger. You're paying 3.25 to take a bond that's on the low end, a quite low end of investment grade. Yeah, I don't like that. So then I start thinking, okay, Josh, well, is that worth the risk? I just don't think it is. I don't think it is. Because I'm like sitting there thinking, if there's a better option, and I think the better option, let me share with you what the better option is. Oh, look at that Pablo. What a good puppy. I love that puppy. I love the puppy, Pablo. Pablo doesn't like my talk about bonds and stocks. That's why he's sitting over there. He likes when I talk about taxes. That's when he gets on my shoulder like a parrot, Pablo the parrot. All right, so we're going to talk about Kroger on a different consideration here. Because remember, Kroger is a publicly traded company, and they issue debt to public people. Anyone can buy a Kroger bond, absolutely. But what if you said, let's look at the Kroger stock. So Kroger stock that's KR, so that's traded on the New York Stock Exchange. Right now it's at 28. We'll just say roughly 28. All right. It's got a PE ratio of 14.26. I have not looked at any numbers. I haven't looked at any financials or anything like that. But our man Dougie here already owns the bond, so I'd say, man, you might want to reconsider this. It's got a dividend. The actual dividend is 0.16. Oops, 0.16, and so we got to take our trusty calculator, which I got way over here. So let's take a look. We do 0.16. I imagine it pays quarterly, so 0.16 times 4. Oops, 0.16 times 4 equals 64 cents divided by 28. Yeah, so it's got dividend yield. So this is a quarterly. So every quarter pays 16 cents a share, and it gives us a yield of 2.27. All right, 2.27%. All right, so what we have here. So Kroger, the bonds are low investment grade. The stock, on the other hand, who knows what the stock? I mean, look, I don't trust any of these rating agencies on stocks because they don't know any more than you or I. But the facts are, we do have, they're making money. They have a quite low PE. They have a decent dividend yield of 2.27. All right, so the what happens here, let's just say you could put $10,000 into the bond or the stock. So if you put $10,000 into the stock, the worst thing could happen, go to zero. That's a fact. You could lose all your money. $10,000 in the bond. Well, if Kroger went bankrupt, do you really think you're going to get that $10,000 back? I mean, you can just look at GM. You can look at tons of examples of bondholders getting the shaft. I'm just telling you right now. I would suggest that if the company went bankrupt, the bondholders are going to get shafted too. Look, the bondholders come before the stockholders when it comes to proceeds of liquidating the assets. You're not getting anything, man. Let's just be honest. If Kroger were to go kaput, you're losing out. Look, maybe you get $3,500 at most. I don't think so. So in this case, I'm going to assume both have a chance, the equal chance of, let's say there's a 100% chance of going bankrupt here, of losing all your money, and there's a 90% chance to lose all your money here, if you want to say that. That, in my opinion, that's not worth only getting 3.27. And here I get as long as I pay the dividend, 2.27. I'm getting that. All right, now don't forget, qualified dividend income. So that's taxed at 0, 15, or 20, depending on your bracket. This is OI. All right, so if we take, let's just say for simplicity, you're in a 20% tax bracket, and you're getting 2.27 minus 20%, and 3.27 minus your 20% tax bracket. Yeah. So I don't want to do that. I want to do there's no 20% tax bracket. Let's say you're in a 22% tax bracket. So you're getting minus 15%. Minus 15% here, and minus 22%. All right, so after tax yield, 2.27 minus 15%, 2.27 minus 15% is 1.929. So my 1.929, that's my dividend yield. 3.27% minus 22. All right, so 3.27 minus 3.27 minus 22% is 2.55. All right, so here I'm getting 2.55. So the question is it worth, and that's just on a 22% tax bracket. If you're in a 12% tax bracket, it's even better for the stock because you're not paying any dividend tax on that whatsoever. So the question, the difference between 2.55 minus 1.92 is 63 basis points. So I'm getting basically, divided by 1.92, I'm getting 0.63 divided by 1.929. I'm getting a 33% better, more money bang for my buck by owning the bonds just when it comes to the income. That's it. So 33% more after taxes. All right, 33% more after tax. I'm going to say a little bit less risk, not much, a little bit, but there's no upside here at all. None whatsoever. The bonds mature at 100. We know that for a fact. The stock has significant upside. The stock has literally unlimited upside. So let's take a look at what Kroger has done over the last few years here. Charts. Let's take a gander, shall we? We'll gander on this. So Kroger. Let's take a look here. Let's say for the last 10 years, just for simplicity, Kroger, look at all those dividends, man. I mean, it's just paid dividends upon dividends upon dividends. Yeah, I can't tell. I'm looking at MarketWatch. I can't tell what this, I can't tell these charts, man. So let's look at finance.yahoo.com. KR is a ticker. I can't follow the market. I love the MarketWatch for real-time stuff, but man, their charts I can't follow. So Kroger, KR, and I have no clue. I mean, over the last 10 years, I literally have no idea at all. It might be worse. It might be better. I just don't know. So if we can get Yahoo to share some info with us. I wish I could pause this while I'm looking this up, but I can't pause the phone. Dude, you going to show this to me or what, man? Yahoo Finance. They got so many ads on here. It takes forever to load. All right, so while that's loading, let's, oh my land, for the love of the good Lord. Let's go up here then. Symbols, Kroger. There we go, the Kroger company. You going to show this to me or what, man? All right, so Kroger, hold on just a second. 10 years ago was trading. Oh, yeah, look at that, man. So I just had it. So Kroger, and I just lost. Yeah, well, over, there we go. So Kroger, 10 years, come on, man. They just had it. Okay. So Kroger in 1999, when this guy was issued, was trading at, is that, I can't even tell. Was that $7, $8? It's up 379% from 1999, roughly 11, but depending on when you bought it. So Kroger has more than tripled in value. So it's got, well, hell, more than that. It's gone up from 1999 right there, trading at $9.44, and now it's at $28.39. That's adjusted for dividends, by the way. So that means you're adding shares, so you have a whole lot more shares on top of a significant higher price as well. It's not even debatable which has been a better investment here, the bond or the stock, not even debatable. So not only do you have dividends upon dividends upon dividends you received for the last 20 years, you have a share price that's gone up from, like I said, 8-something to 28 what it is right now. Not even debatable, man. Not even debatable. So I wouldn't buy the bond. I'd buy the stock. I say, look, if I want to have safety, go buy the Ginnie Mae, go to the G fund or the TSP, go to CDs. There's absolutely no reason to take the risk on for bonds for a 33% more in income, but no upside at all. Just don't do that. Buy the stock, avoid the bonds. There's no reason to own a corporate bond, in my opinion. I don't see any reason whatsoever. Just buy Ginnie Mae, government bond. If you want to buy the Vanguard Bond Index Fund, that's 75% in government-sponsored entities, enterprises, and treasuries, and Ginnie Mae's, by all means do so. It's a heavily government bond with some corporates thrown in there, or buy CDs or buy the G Fund over the TSP. But it's just more proof to stay away from bonds. It's not worth the risk. All right, see ya.